Welcome to my channel. We have the first week of the big earnings kickoff. Next week's going to be even bigger, and I'll explain and release some dates to some of the large companies, especially some that I hold in my portfolio. But today I want to talk about 3 companies. 2 are in my portfolio and 1 is not. And I think it's always good to look at the numbers. People like to go off of what they hear, their emotions. I like to take that out of it and look at the numbers and analyze it and determine, hey, is this something that I should buy more of? Should I stay away from it? So that's what we're going to talk about. So we're going to get right into it. We're going to talk about the first company, which is a company I own in my portfolio, and that's S&P Global. Now, their quarterly revenue hit a new record of $3.575 billion, which was a 16% increase year over year. Now, the company does expect to execute additional accelerated share repurchases totaling $1.3 billion in the coming weeks. So that's a great sign when they buy back their shares. That means we have more ownership in that company. They're not diluting us, and usually the stock tends to go up when a company buys back its shares. They also are raising full year guidance. All good news. Now, from the CEO himself, Douglas Peterson, he said, S&P Global delivered exceptional financial results in the third quarter. The company continues to serve its customers with world-class benchmarks, data and insights, and workflow tools, while we invest in innovation that will generate growth and create long-term value for our shareholders. The company is as strong as it ever has been. I am excited to see such a talented team of executives preparing to lead this incredible company into the future with the experience, track record, and passion to deliver strong results for years to come. This is a great message from the CEO. But again, we're looking at the numbers. So revenue, as stated, increased 16% year over year. So you'll see from third quarter of 23 to third quarter 24, it went up. And overall, for maybe except for one quarter, revenue is going up quarter over quarter. Now, I saw this and thought this would be good to see. It's always good to break out the revenue per segment of the company. So right here, we will see that revenue, again, overall increased at 16%, but it was the ratings business that was the big winner with a 36% increase year over year. That is huge. This is the bread and butter of this company. That's excellent and great to see. Then the indices went up 18% year over year, another strong, solid number. Now, some of the other ones was mobility went up 9%, commodity insights 9%, and market intelligence 6%. Overall, again, that 16% increase, a very healthy number. So net income increased year over year. So you look at the third quarter 24 versus third quarter 2023. It did tick down a little bit from last quarter, but year over year is what you really want to pay attention to, because some companies have cycles, right? Just like the 4 seasons of the weather, some companies might have stronger quarters based on certain economic factors, whatever services and products that it's providing. So you think of Amazon, of course, they're going to have huge fourth quarter blowouts because that's the holidays. So year over year, comparing the quarters is a good thing, and it's going up. Long-term debt is staying relatively flat. We have a little bit of a slight decrease. You can't really see it on here. It's so small. But so nothing new. That's good. Of course, when it popped up there, that was due to an acquisition. And then third quarter operating profit, expense, and operating margin. Just want to highlight that the profit margin increased 530 basis points to 40.1, and adjusted operating profit margin increased 180 basis points to 48.8. This was, of course, mainly due to that ratings, revenue growth, and the indices as well. Great numbers, as well as the earnings per share. They grew 33% year over year when it's a GAAP diluted. Adjusted diluted was 21%. Very strong numbers. So I want to end talking about each stock with the price target from analysts. Again, this is something that all the professionals in the world can come up with their price predictions, but you can't for sure pinpoint that. They've been wrong many times, but I think the majority of the times they're always at least in the right direction and somewhat accurate. So this says that we have a 16% upside potential. Right now, the stock is hovering around 490. So I think that I would buy in if this stock did dip below that 470. It's a little pricey, but you're paying for a very sturdy, solid company with solid growth. This isn't going to be some, early Tesla kind of explosive growth company, but I think it'll provide solid growth that will allow you to sleep at night. And I do think that this company definitely can reach that mean of $572. So it's something I really need to think about. Maybe I will buy in now that it dipped below $500 per share. It was up towards like $530. Right now, I do agree that this company is teetering on a buy. So yeah, if it comes down a little bit more closer to that 470, I will buy. Next company is the almighty Tesla. Now, just a few things from its summary of its earnings. They delivered strong results overall with growth in vehicle deliveries both sequentially and year over year, resulting in record third quarter volumes. Tesla also recognized their second highest quarter of regulatory credit revenues as other OEMs are still behind in meeting emissions requirements. Now, their cost of goods sold per vehicle came down to its lowest level ever at $35,100. So they're really focusing on making their vehicles very affordable because they want the world to transition to sustainable energy, and that it obviously would highly benefit Tesla. Really, the overview I just want to talk about from this third quarter was the profit beat, improving margins, improved growth outlook, cheap EV update, a robo-taxi rollout. We saw their event with the robots, with the autonomous driving promises, and that resulted in a 20% pop in the stock when they released their earnings, which we're going to look at their stock chart here in just a second. But first, just to show you that they produced approximately almost 470,000 vehicles and delivered near 463,000 vehicles. This was really good numbers. It's showing almost like Tesla's bouncing back. It had, almost a year of some troubles. A lot of people were worrying that due to the high competition, this company might have just run out of luck, but it is coming back, so that should make you somewhat excited as a Tesla owner. And there's that stock. It jumped up 20% there, but year to date, it's just up about 7.8%. It's kind of been struggling. Revenue is up 8% year over year, so third quarter versus third quarter. And overall, revenue's kind of been staying stagnant, right? We're not seeing that growth like we would in a Microsoft or anything like that. And if we break it down, total automotive revenues is up 2% year over year. So that is something you do not want to see with any company with revenue only growing 2%. But luckily for Tesla, but I am going to have something to say about this, their energy generation and storage revenue is growing 52% year over year, and their services and other revenues growing 29%. Though those numbers are high, they still make up a small percentage of total revenue. Therefore, the average really got brought down by those automotive revenues to that 8% overall. And I will say this, to me, Tesla is still mainly a car company. It has a lot to prove still. It's showing some promise here, but I would like to see the other sources of revenue besides automotive make up between 50 and 70% of their revenue in order for me to have some confidence in Tesla. And right now, due to how expensive this company is, it's just not a comfortable spot for me to be in to even consider this, but that's just me. Net income slightly ticked up quarter over quarter, we'll see here, and long-term debt went down very slightly, so hey, we'll take that. So the bottom line from analysts is that Tesla is charging up for a new wave of growth due to these inexpensive models that should be coming out during next year. And of course, inexpensive models should generate some more purchases from customers. That's just how it works. So yes, I will agree that I do think they have another wave of growth. Not only that, but their margins are rebounding. The adjusted EBITDA margin bounced back up towards 19%. It's had a struggle for over a year now. So again, Tesla's having a rebound in general, but I would still be cautious with this company. It is extremely expensive of an investment. It's also, by analysts, is showing a 16% downside, and I do have to agree here. Look at that range of price, anywhere from $315 to $85 per share. I personally would buy below $85 per share. Shall I say consider it? I'm still not confident in this company yet. It still has a lot to prove. People are investing in that future that's 20 to 50 years down the road. That's how much hype people are putting into this, that I think it's going to take a long time for a lot of this technology to be advanced enough to fulfill what people want, as well as pass a lot of regulatory hurdles. So I say if you are bullish on Tesla, you might want to buckle up and just sit back and relax for a while. It's not something that I want to do. I don't want to wait that long for a company to prove itself. I want to wait till it starts proving itself. this rebound isn't enough for me. Like I said, I want to see those revenues other than automotive make up 50 to 70% of that total revenue. So not a buy for me. I would not buy this company. It has a huge capex. It has a lot of things that still needs to work out to bring promises. As we know, Elon likes to promise things and they usually don't happen right away. They're very delayed, but we'll see. It's an exciting company to follow. By no means am I saying Tesla's going to fail. I think they have a very good chance of succeeding, but I just need to see more personally. Lastly is Union Pacific, the railroad company. Now, this might be a boring stock. You might be like, I might skip this, but boring stocks sometimes are the best investments because they provide stability. They provide stable growth, and you can sleep well at night. Again, just like S&P Global, Union Pacific is another one. Railroad transportation is not going anywhere anytime soon in any probably lifetime of mine. And so for that reason, let's look at their earnings. So financial performance was driven by increased revenue and improved operational efficiency. That's very important for these railroad companies, is to improve efficiency because they only have so much they can do other than that, right? These railroads are built out. They're kind of how they are. And so they really need to focus on just making things more efficient. So earnings per share went up, operating revenue went up, operating income went up, operating ratio went down, freight car velocity went up, and workforce productivity went up. All numbers moving in the right direction. So Union Pacific, their revenue went up 3% year over year to $6.09 billion, which fell short of analyst expectations of $6.14 billion. Not a big deal to me. And net income rose 9% year over year to $1.671 billion. And I will say this income here is remaining strong. Again, companies have high CapEx, so this is showing me that they're managing their expenses well. And then I just want to show, I don't have a slide for this, but their earnings per share was $2.75, which was slightly below the $2.78 expected number from analysts. Again, not a big deal for me. Long-term debt, this was a surprise. It went down pretty drastically. I will say this was not highlighted anywhere, and it should have been. This is very important. This is creating a lot more freedom for this company. And for me, that just signals a stronger financial position. And then I want to show you this driving strong cash and returns to shareholders chart. So this company generated $6.7 billion in cash from operations year to date, as well as returned $3.2 billion to shareholders. Now, in the upper right hand there, you'll see that cash from operations went up 12%. And then you'll see free cash flows of $1.9 billion, which is up 94% when comparing year to date 24 versus year to date 23. Very strong numbers. I was very happy to see this. So looking ahead, Union Pacific expects the fourth quarter performance to remain consistent with the third quarter, with an improvement over the previous year. The company remains optimistic about its earnings prospects, citing strong service offerings, enhanced network efficiency, and robust pricing. It also plans to repurchase $1.5 billion in stock for 2024 and maintains a capital plan of approximately $3.4 billion. Talking about efficiency, we'll see here, locomotive productivity was up 5%, workforce productivity was up 12%, and train length remained flat. So with its analysts and price predictions, it has an upside potential of 12%. Right now, it's hovering around $230 per share. I would buy this stock probably closer to 200, maybe a little bit below. It's one that needs to demand a little bit more for me to buy into it because it's not a high growth company, but it's a solid growth. So I definitely want to get in at a level where I feel I have some good upside potential. So I think it'll narrow by, in my opinion, at or below 200. So looking at my portfolio, which is up 28%, which is down a little bit from last time. It finally reached 30% in the green. But we've had some, earnings this week, and it caused some stocks to go up, some stocks to go down. But there is S&P Global, which is up for me 36.79%. Very healthy numbers, as well as Union Pacific, which is up a solid 17.5%. Now, S&P Global makes up 11.46% of my portfolio, and Union Pacific 6.69%. So they're very healthy positions, and they're healthily in the green. And I consider these quality companies in this portfolio, except for Warner Bros. I'm planning on selling that, but I don't want to sell quite at the loss right now. I think there's some potential there. But let me know if you have any questions. I also want to hear what you think of any of the companies that released earnings this week, especially the three that I mentioned. And if you agree with my kind of prediction, my price points that I would buy into them. And then next week is going to be a big earnings week. In fact, I have here, just to share with you guys, Microsoft will report on October 30th, Amazon on October 31st, Vici on October 31st. Realty Income isn't till November 14th. Apple's on October 31st, Google's on October 29th, and Meta on October 30th. So some big earnings to come, which I will definitely have some discussions about, hopefully all of them, and make a video talking about them because I think it's very important. A lot of these stocks, a lot of people are invested in, and they're ones that are very important and also steer other companies in the market. So with that said, I hope you guys have a great day, and we'll talk to you soon on Mark Arnold's Finance.